Thanks for taking the time to be with us today. My name is Craig Gordon. I'm one of the vice presidents at Prevail, and I'm excited to share what I believe are some impactful strategies on creating wealth in a chaotic environment, or certainly an environment that is far different than maybe what we're used to. At Prevail, we believe the financial services industry has done somewhat of a disservice to individuals, primarily because they're focusing almost all their attention on the accumulation phase. And while that's certainly important, we would argue that it's the distribution phase, both to yourself as well as maybe how you want to pass wealth on to others, that's far more important. And how you accumulate, where you accumulate, matters. And so today we're going to share some strategies, some approaches to maybe allow you to think differently. And I want to introduce friend and colleague Andrew Stafford. Andrew is our president at Prevail. And beyond that, I think he's one of the most creative and unique individuals here to help folks build wealth and think more strategically on how they approach that phase of their life. So with that, Andrew.
Craig, thank you. It's an awful nice introduction. I always like to follow an introduction like that with the disclosure page, which is the disclaimer here. We are going to talk about financials. We are going to talk about investing and things of that nature. So it is important that we get this up there, and then we'll get to what's really important. What is today's discussion about? Craig touched on it a little bit. We want to go through how the investment climate today is significantly different and why it is that way. We're going to talk about volatility and owning volatility. We're also going to go through, Craig's going to touch on diversification. We're going to call it more of a universal diversification, because what you think when you hear that word is going to be very different than how we describe it, and probably how your traditional advisor describes it. We're going to go through our approach and then what's next. But if there's really three key takeaways that we would like you to walk away from this particular seminar with, it's number one, we talked about it. We're going to show you this is a very unique environment. Prevail is different, and we've built our organization for this type of economic climate and whatever economic climate may come. And lastly, we believe when you work with Prevail, you will come out better in the end. So let's dive right into it. If we're going to tell you that we believe financial services and the way that financial services is delivered is wrong, and the type of advice that people are getting is wrong, let's jump all the way back to how did we get here, how did it start, and the investing myth of buy and hold. At Prevail, we believe, as I mentioned, this is antiquated, and we're going to talk about why that is. So let's start with, if you go out and you search the traditional investing theory, buy and hold, on the internet, here's something that comes up, easy to find. If you want to make money in the stock market with a time-tested method, and that's one of my favorite comments on there, a time-tested method, generally meaning it's old, you should consider buying and holding stocks. With the buy and hold approach, investors buy stocks and hold them for a year and more. So how did we get here? If we're going to talk about a buy and hold strategy, then let's talk about why that came about and what we think is wrong with traditional investing. And that is how traditional investment advisors build and create portfolios. So if you were to go to any type of traditional investment firm, whether it be here, national, it really doesn't matter what their name is, you're going to go through some form of risk tolerance survey. We do the same thing here. That's going to basically put you into one of 4 or 5 categories. And you are now labeled. You're either a conservative investor, your balanced growth, could be aggressive growth, some combination in between. And the reason that they do this is what is extremely important. Not whether or not you fit into this profile. This is probably correct. But the reason that they do this is in order for an investment advisor to scale or grow, they have to make investing simple, and they get away from what we'll call customization. It's very easy to control this. It's marketable because they'll tell you, hey, you are in an actively managed portfolio. And technically they're correct, but most importantly, when you get down to it, these are built to gather assets under management or gather clients' accounts and pull them in. And why is that? Because inside of each one of these portfolios, they can make one change and blow that portfolio out to all of the clients that have now been labeled balanced growth, aggressive growth, or conservative. So the question for you is, Does everyone really fit into a few categories? And more importantly, is that really customized? I would tell you that it's not. We believe that risk is relative, and therefore labeling someone in some form of risk tolerance from now until the end of time, or until you ask them to maybe go through and do a different type of survey, is just wrong. And we believe that because not all market cycles are alike. So let's start with, this is a chart of the S&P 500, okay? And it's basically taking this from year to date through October. Look at the run-up of the markets year to date. Do you feel the same way about risk when the markets are hitting all-time record highs as you did when it was way down there? Would you want to say, hey, I'm completely fine and staying in the exact same type of investments? Don't pull any money off the table. Don't make any adjustments. I'm aggressive. Let's ride it out. Let's go back 2 years, right? Look at the market growth in this chart over the last 2 years. Same chart, S&P 500. Do you still feel the same way about risk right here with that level of growth? Let's take another look at it. Let's go to the 5-year chart, okay? Same S&P 500 index. We're at a 5-year time frame. Look at the growth of this over this time frame. Do you still feel the same about risk? I would say that if you were in a true environment where your advisors are working with you and your advisors are constantly saying, hey, should we begin to make adjustments? Let's look at the volatility that potentially could be coming, or the volatility that we've had in the market, and let's use it as an asset class. I would ask the question, do you really want to ride out this next phase? Maybe, maybe not. Let's look at some actual fundamentals or some statistics of the same S&P 500 index that we talked about. So this is going back to 1996. It comes up through 2021. We're at September 30th, 2021 on this particular segment that we're looking at. And what I want to point out is what we'll call the forward PE ratio of the S&P 500 as a whole. As you look at this basic time frame here, it's at 20.31. Now, why does that matter to you? Okay, it matters to you because a forward PE ratio is merely a scale to say, how is this priced compared to historical norms? It's basically determining, is it on sale? Is it overpriced? It's the same way you would approach buying any large asset, be a home, be a car. How is it relative to historic averages? When we look at it right now at 20.31 times, the average over the last 25 years is 16.78. 16.78. So why does that matter? It tells us the markets are on a heck of a run, and near perfection has been priced going forward into the markets in order to keep this level of price or this level of run-up. So if we're going to talk about these markets being different, I think it's important to say what causes volatility. Well, anybody that looks over the last 3 to 6 months, chaos has been built into the market. And so as Craig opened us up, he said, look, how do you make money out of chaos? If you go out and you just type in chaos into the internet again, complete disorder and confusion, it doesn't take very long for all different types of headlines to come up that have moved the market. Unbelievable amount of chaos. And what's been amazing is the markets have continued to perform through all of this. Some up, some down. But as we look at the actual numbers, and we're going to get into why is volatility important, this is the volatility, or what is referred to as the VIX, the volatility index over that same time frame that I just pulled up those headlines. And what the volatility index does is it goes over here and it starts at a baseline of 0, and it comes across and it says how crazy or how much movement is happening inside the market. This is that same 6-month time frame. So if we know the volatility is built in there, and then I think, again, it's important to look at charts and see what it means and how does that relate, we go back to the same S&P 500 index, same time frame. This is over the last quarter, okay? The markets began to pull back, but look at what they did before they came to pull back. What we know in investing is greed can be a killer. Just saying, hey, I want to ride it out is no different than going to the casino and you're way up on the blackjack table and you're feeling good about where things are at. How many times have you wished you would have walked away? Most of the time people are walking over to the ATM because they wrote it up and they came back and they're trying to win their way out of their losses. Over the last 3 months, the last quarter, markets pulled back, volatility was here. Now, why are we different? We don't try to time the markets. We don't believe that that is a good approach. But what we do believe is setting proper entry and exit points allows you to take profits along the way using technical analysis to determine, is the volatility, is the chart changing, is this the right time to be in, is this the right time to pull out? It allows us to make better decisions versus riding it up and ultimately coming back down. We believe there's a better way, and we're going to go through that. I think this is going to be one of the most impactful segments that we talk throughout this presentation today. So I've talked about chaos being here over the last 3 months, but it's accelerating. Chaos or volatility, as we would determine it, has always been in the market, right? But it is accelerating at a pace that has been pretty historic, and we're going to walk through that. This is basically the same chart that we've been looking at, which is the S&P 500 over a 41-year time frame. And it's showing where the S&P 500 ended the year at from a total return standpoint. What I think is amazing is look at every single year almost in this chart, how much the market has been down. So 31 of the 41 years on this chart, the market ended up positive. But as we look at it, 7 out of 10 years, so roughly 70% of the time, the markets have some form of inter-year decline of greater than 10%. At some point in time, even though 31 of the 41 years they ended up significantly, they were down 10%. So instead of allowing this to affect your portfolios, and by the way, when you go down 16%, the market has to come back more than 16% to get you back to zero. Drawdowns are the biggest detriment to an overall portfolio over a long period of time. But using this market chaos to our advantage, we will move in and out of holdings based upon expected return versus just riding it out. Now, let's go to a couple things that I think are critical that will prove the point that this market that we're talking about over the last 15 plus years is significantly different. What's changed? What's caused this drastic adjustment? First of all, the globalization of our markets is a main factor. We are no longer just connected to the United States. What happens here is no longer the only thing that impacts our economy. So all of the other markets you can see will begin to move and adjust. We have become interdependent or intertwined with the global markets. That's a significant change. More importantly, the speed of travel or the pace of information that is going on right now in the markets is unprecedented. There are organizations that will actually try to move closer to the trading facilities to be able to get trades in faster than others to save fractions of a percentage point. The Federal Reserve and government intervention. This again has been unprecedented. What the Federal Reserve has done in what they will refer to as quantitative easing, or in essence, adding liquidity into the stock market, making money cheap in essence, is what they've been doing. Again, unprecedented, and they've been doing it since 2009 in the Great Recession. So there has been a long period now of federal intervention into our markets. The government intervention is the same. So look at the pandemic response, okay? If roughly 70% of the GDP in the United States, meaning the gross domestic product, all of the things we sell and buy, 70% of it is generally driven by consumer spending. So if you have a pandemic and shut everything down, how do you prop up and keep markets going? Well, you flush the economy with cash. You send out stimulus checks. What does that do? That allows everyone out there to continue to buy from Amazon and all the other places that they go to buy products. It props up the markets. These two things at the bottom are unprecedented. And what is it causing? What is the change? Well, this is where you're going to see the impact. And this is why we will tell you you need to begin thinking about investing and the markets as a whole differently. What this is showing is this is a chart by decade, going back starting in the 1940s. And it is charting how many individual days the market moved more than 2%, which is the dark blue, and more than 3%, which is the light blue. I hope that you find this as interesting as I do. From 1940 to 99, so roughly 59 years, the market had 450 total trading days of 2% or more during that time frame. They had 113 days of 3% or more. Fast forward to 2000 and beyond, as we've talked about the impact of speed of information, globalization, government intervention, all of the things that we talked about on that previous page, from 2000 to 19, just in 19 years, the market had 394 days of 2% or more. They had 137 days of 3% or more. They've already surpassed a 60-year time frame of 3% or more market movement. And if you were to extrapolate this out during the same time frame, it's basically on pace for a threefold. That's unbelievable. But let's take it even further. If you go back and you look at the S&P 500, basically since 1967, the table shows the largest intraday point swings. Okay? Of the top 20 largest intraday point swings, 18 out of 20 were from 2020. 18 out of 20 were from 2020. And not one of them on there is from pre-2000. Move it forward, take the same chart, but let's look at starting to closing changes within the market. Of the top 40 largest closing point changes, 30 of the 40 were in 20 and 21. And again, all 40 were from 2000 and beyond. So do you believe volatility is here to stay? We do. And it's ever more important that you begin thinking and investing and changing the way that you work with your financial advisors. Now, we built a large investment firm. We've done it the old way. We built a $5 billion RIA before and did it just like everyone else. And we had an opportunity to start over. We had an opportunity to look and do things different for clients. We had an opportunity to say, how do we impact the lives? And our mission, our focus, was to educate individuals and families on alternative ways to meet their financial objectives, but moreover, to give you back control. But it takes a different perspective. And for that different perspective, I'm going to kick it over to Craig to give you a little bit different version, plus you won't have to sit here and listen to me the entire time.
Well, thanks, Andrew. And I hope everybody that's watching can appreciate, again, that things have changed. And how do you deal with that? How do you take advantage of the chaos to make it more opportunistic? And it's not just taking advantage of different perspectives, it's really taking advantage of different approaches. The majority of the industry, and really not to the fault of their own because they've been trained to do it, are in the asset accumulation or the asset management business, meaning that they manage those assets, they hope to get a return, they hope to limit risk, limit loss. But managing is very different from creating. At Prevail, we believe in helping individuals create wealth, to leverage that wealth, and protect that wealth. As a result, we've put very unique strategies and approaches in place. For those of you that are aware of how we work, you'll know that we pay a lot of attention to tax mitigation. Why? Because we believe it's one of the largest headwinds to impeding not only the accumulation, but the net distribution of that wealth. How do you transfer assets into a tax-free environment? How do you begin to add in alternative asset classes that are non-correlated with the market so that when the market goes up and down, like Andrew showed, you're not affected as much? Being strategic with the investment management approach, not just passive, not just buy and hold, although there may be a portion of your portfolio where that makes sense, but to be strategic and taking advantage of when the markets goes down, taking advantage of various sectors in the movement that exists today. And really that boils down on focusing on diversification. But it's not just diversification in the terms of what we have been taught, which is don't put all your eggs in one basket. But like so many things, it's more than just a statement. Now, what the industry will classify, and I love these approaches, is they talk about diversification as spreading out your assets primarily between stocks, bonds, cash. Charles Schwab, JP Morgan here, a mix of different asset classes, invest in assortment of industries. My favorite, spread your bets around the globe, kind of goes back to what Andrew was talking about and related to the casinos, or hold a range of individual securities. But we believe diversification is far greater than that, to truly take advantage of a variety of mix of asset classes so that you mitigate the market downs, take advantage of the market upswings, but combine it with a variety of asset management tools, variety of different vehicles to do just what Andrew talked about, maximize control. Gain control over your financial future. So let's go into each one of these. And each one we're going to dive a little bit deeper into. But the first, tax diversification. Of all the hundreds and thousands of places you can put your money, from a tax perspective, there's only 3 buckets. It's tax deferred, 401ks, IRAs, taxable, mutual funds, brokerage accounts, money market savings, and tax-free. Asset class diversification. Again, taking advantage of non-correlated asset classes, maybe like real estate. We'll talk a little bit more about that. Public versus private. This is really interesting because public type asset classes are going to be really determined by various macroeconomic forces. Now that can be advantageous in some cases, it can be detrimental. How are you then mixing in various public offerings as well? Time diversification. I think this is one thing that is very often looked, but we've all got short-term needs. We've got midterm, we've got long-term needs. As a result, there's various risk perspectives that need to be taken into consideration along those lines, as well as liquidity considerations. What about concentration? Now, for those business owners that are listening, more than likely you've probably got 80 to 90% of your net worth tied up in a business. And why that's understandable and probably makes sense from a return perspective, it certainly creates a concentration of wealth. For those of you that have got a lot of money in your 401ks because you thought that was the right place to put it, you've got matches and we've accumulated significant dollars. Great problem to have, but nonetheless, a concentration of wealth. How do you deconcentrate that? And last, this whole idea of liquidity. And one of the things that I think Andrew and I could both agree on, and maybe those of you who are listening, is for individuals that we would perceive as been successful from a financial perspective, most of them have been able to take advantage of opportunities when opportunities created themselves. And a lot of that boils down into what was their liquidity, what was their cash position to be able to act quickly. We'll talk about that. So let's go into tax diversification, one of our favorite items. Now, if I were to poll the audience here, all of you, what I'd likely find is that 80% of your net worth is tied up in this bucket, primarily because of 401ks, other employer-sponsored plans, IRAs, et cetera, et cetera. You'll have 15% or more in maybe a taxable account, right? Money market savings, brokerage account, et cetera, but very little to none in a tax-free environment. Now, why might that matter? Well, the reality of tax deferred, as advantageous as it is, if I make $100,000, I put $10,000 into this bucket, now I'm only taxed on $90,000. Pretty good deal. The challenge is that all of that $10,000 and all of its growth and everything else that I contribute is going to be taxed at whatever rate I'm in at the time of distribution. Now, to understand why that might be a problem, we got to look at the fundamentals. We got to look at the fundamentals of the U.S. financial system. Right now, we are at an historical high from a debt perspective. This chart right here in 2020 shows 27 trillion. Pause for a moment. Does anybody know what the current national debt is as of today? It's $28.8 trillion, and we're about to add another trillion or more on top of it with some new spending. We are at unprecedented levels. In fact, we're about the highest levels we have been since World War II. We've got certain deficit spendings. We've got various revenues that are lower than what we're bringing in. And if we were all running each of our households like that, or if I was running a business and I'm spending more than I'm bringing in, I've got a couple choices to make. I can either cut costs, reduce spending, or increase revenues. Well, how does the government increase revenues? They're not terribly very good at cutting costs. How do they increase revenues? Well, they do it through taxes. Now, we're going to focus most of the attention here on income tax. Of course, there's a variety of taxes that they can do. Now, if I were to poll everybody and say, how do you feel about taxes? Well, after the groans and the moans, you'd say, well, they're high, I pay too much. I need to figure out a way to reduce it. And that may feel that way. But when you take a step back and you look at it historically, what you'll find is that we are and have been in a low historical tax rate environment. Over on the far right screen there is our top marginal tax rate at 37%. Anybody want to know what the highest amount is? You can't probably see that, it's too small. 94%. 94 cents of every dollar back in 1944 for those that made over $200,000 of income went to the federal government. And there's lots of room for movement back and forth. So I don't necessarily know where tax rates are going to go in the future, but I know there's lots of room and precedent for there to change, and likely they will be far greater in the future than they are right now. Well, why does that matter? Why is that concerning to the clients that we work for? Well, again, if I go back to this chart and I've got 80% of my net worth tied up in a tax-deferred bucket, and I've got $1 million, $2 million, $3 million, $5 million, doesn't matter. The reality is I don't have that number. I've got whatever the IRS says that I have at the time of distribution. And to simplify that further, if I had $1 million and I were to take all of that money, which I recognize you wouldn't do, but if we were to take all that money back in 1980, I'd only be left with $300,000. Had I just waited 10 years, I'd be left with $720,000. If we all had a crystal ball, we could probably pick the time and duration to maximize that. But the problem is we don't. So how do we transfer assets into a tax-free environment, diversify against that tax rate risk to put us in more control? Very simply, if we can shift dollars, reposition, reallocate dollars into the bucket so that we're still taking advantage of the tax defer, there's advantages to doing that. But we're shifting some dollars into some taxable and more so into some tax-free. That, simplistically, can put us in more control. Now, if we go to the alternatives, hopefully many of you know what I mean when I say alternative asset classes. This is real estate, hedge funds, private equity, variety of different things, derivatives, et cetera, et cetera. Most of those alternatives have been part of portfolios, although I'd argue that they've been reserved for more of the higher net worth, higher income. And they certainly have accessibility for everyone, but they've been a part of the portfolio. But what's interesting is as we've progressed through time, if you look back in 1996, this chart that you're seeing here, 10% of the portfolio here was traditional, 5% of the portfolio was alternatives, okay? But that 5% drew, almost 90%, 95% was traditional, 5% was alternative, but that 5% drove 10% return. Go all the way, fast forward to 2019, we've increased our alternatives, but that 26% has driven 40% of the return inside a portfolio. So how many people think we need to begin to think about adding alternatives to our portfolio to increase not only the return, but diversify the various risks associated with it? Now, there's all kinds of different alternatives that I've mentioned. What we're going to zero in on, and we believe is a very good asset class, is real estate. And I can tell you, working with many individuals, that real estate can encompass and usually is a very good hedge because it's a non-correlated to the market. Now, there's certain risks associated with it, of course, but as the market is doing various things, real estate typically is insulated and vice versa. Now, there's lots of ways to invest in real estate, all the way from I want to go and be part of a mutual fund, basket of real estate, a real estate investment trust or a REIT, to I want to own a single family home. But there's this space in the middle, and that space in the middle is where we typically live, connecting individuals with private off-market real estate that, one, they can see, they can touch, they can go visit, but that's not going to call them when the water heater goes out in the middle of the night. So there's a variety of space to go through there. We've got, typically, we have a whole committee that goes through a variety of real estate offerings. We look at dozens and dozens of them before we find one that makes sense. There's a variety of different parameters. This is one that we most recently looked at. down in Texas. But again, from a yield perspective, where you're putting money in and you're getting income regularly off of it, to opportunistic. I put money in, maybe I'm not getting a lot of income off it, but I'm going to sell it or I'm going to offload it here in a few years and take advantage of the appreciation. So there's a variety of different opportunities and things to take advantage of, and it's important to obviously coordinate that with the portfolio. But real estate, as an alternative asset class, can be significant in the form of further diversifying that portfolio and taking advantage of a variety of different market conditions. Time diversification. Now, I'm going to have Andrew go through this a little bit because there's more thought behind this particular aspect. But again, to recap, we've all got short-term dollar needs, midterm, long-term. We've got various liquidity. We've got various risk profiles. It's multidimensional as it relates to time. And so Andrew's going to walk you through why this is important and specifically show you the impact of thinking this way can have on your portfolio.
Thanks, Craig. Yeah, as we begin to kind of wind this down, this is an area that we feel is really, really impactful in how you plan and create wealth. So we've talked about volatility. We term it chaos. As Craig mentioned here, diversification as far as time is concerned is three-dimensional. He mentioned that earlier. If we were to go back and bring up the real estate deal that he talked about for a second, that's extremely important. But where does it fit? Is it in a long term? Is it in a midterm? Is it in a short term? Where does it fit from a risk profile standpoint? Do each one of your buckets have their own risk profile associated with them? Are your needs as far as where you're going to be able to grab cash to take advantage of chaos? Is that properly positioned? All of these things are put together in developing and creating wealth. And let's get into what we mean by an example. So we talked earlier about buy and hold. And buy and hold might not be right for everybody. But if there were a segment to be able to give a good example of time diversification where buy and hold would be important, let's talk about the long-term bucket, right? The long-term bucket would be very important for buy and hold. This is going back to the same chart that I've talked about. The dates are a little bit different, 97 to 15. The reason being is this chart would go so far off the screen if I brought it forward that we wouldn't be able to get it on here. Buy and hold. If you were to invest at the market high, and again, we're using this as an example, no one has timing like this, but if you were to invest at the market high back here in March of 2000 and go all the way to 2015, you'd have a 33.86% rate of return. Most people would look at that and say, okay, that's great. But the question is, what was the journey like?
Emotional.
How did you feel, right? I want to pause for a second. For those of you old enough that had enough net worth to really have it be impactful, do you remember this time frame? 08, 09, markets down, S&P's down 57%, no end in sight. Banks are getting ready to potentially collapse. Our government's meeting on how to put liquidity back in the market. This was a scary time. The problem is most people make their worst decisions during frightening and scary times. And in a buy and hold, a bad decision here impacts all of this. But if you have gone back and looked at time diversification as three-dimensional, and you had a midterm bucket that was liquid, and you had a short-term bucket that was liquid, and you were properly diversified, you don't feel as bad during this time frame as if all of your particular accounts are invested in that and you're in a quote buy and hold. So long-term buckets are okay for this strategy if you encompass that with the rest of the portfolio mix. Most people didn't stay invested, but here's what's important. 60% of the S&P 500 top single session gains occur within 2 weeks of its largest single session loss. I can't tell you how many clients were diving into either cash or different types of investments on this way down and were so scared during this time frame that they didn't get back in. And whereas if you would have rode this out, you probably would have recovered in a balanced portfolio in 18 to 24 months. Some people still hadn't recovered by 15 because they made emotional decisions. So if we go back to the time diversification piece and say, If I'm properly allocated here, I can withstand certain things that happen. I'm not going to make an emotional decision. Let's talk about our approach for what we would look at as a midterm bucket. This is an actual chart for a company with the ticker MNRL. We happen to like this holding at one point in time. It's done really well. We're going to go through and show you an actual example. So, if you were to buy this on 1/4 of 2021 for 11.17, fast forward, we're going to get out of it, hold it through some of this volatility. We sell it on 5/11 for 17.46. Most people would look at that and say, that's a 56.31% rate of return. I'm pretty happy about that. But what if there is a better way to do the same thing with less risk? And this is what we're going to go through. So this again is the exact same chart in RL. It's the exact same time frame. This is how you could potentially, working with our strategies, manage that midterm bucket so your long-term bucket of volatility rests and sits over there. So utilizing the same concept, we buy, same time frame, we buy in 1/4 for 11.17, but because we set entry and exit points and we use our investment advisory committee to do our technical analysis, we exit on 2/17. A sale is actually triggered for 15.93. Now, we still made 42.61%. But you're out there saying, yeah, Andrew, but the buy and hold made significantly more. Here's the thing. We still like this particular holding at this time frame. So what we look at and say, we want to have an opportunity to buy back in. But because we're in volatile environments, we're going to buy in the old terminology, let's call it a dollar cost averaging, or buy in segments for our full position. So on 3/2 of 21, we buy back in for what we would consider a quarter of the full position that we want to hold for 14.43. It rides up, but we still believe it has higher opportunity to go, and we also know that it's a volatile time. So on 3/22, we buy in for another quarter position, this time at 14.30. We ride it out a little bit again, and on 4/5, we buy in for another quarter position at 14.79. You may go back and say, hey, Andrew, you had an opportunity to buy it a lot cheaper here. Why didn't you go all in? Because the chart hadn't told us it was ready to break out. And when the chart tells us it's gone through its cup and handle, it's ready to buy out, we buy our final position. We still buy it at 15.27, right? But we ride it all the way up, we get it out, and made another 25.58% on the same holding. Now, why is that important if I'm sitting there as an investor? Well, first of all, did we improve our performance? 68% versus the 56 on a buy and hold? Yes. But here's where it becomes impactful. We did it with less capital at risk throughout the entire time frame. And at any point in time, we, working with our clients, have more control to be able to make adjustments. And, more importantly, not lose if our decision was bad and that particular account started to go down more. So, the power of momentum, and if we go back to the beginning where we talked about this is a different market, there's volatility in the world, let's own volatility and allow the chaos to create wealth instead of being a victim. I want to show you another example. Now, why do the large organizations struggle to do this? They'll do this if you're an extremely high net worth client. There's no question. They'll bend over backwards for you. But the reason they mostly don't do it is because they want you to fit into one of those risk-based models that we talked about before, where they can make one adjustment and blow it out to thousands of clients. We, again, built Prevail differently. Our intention is not to be the biggest and largest out there. Our intention is to impact the lives of our clients and help them create wealth versus merely manage their wealth. In this particular example, we'll show you how we cut profits and also negatively cut losses early if we don't like something. This is a basket of individual holdings that we had put together for our client. And what it will do is it'll go and show you. The average days held for this particular group was 60 days. Average days held. We had one particular holding in here we didn't even hold for a full day. And you'd ask yourself, why is that? Because in one day, we made almost 10%. If we believe greed is a killer, and we have a philosophical approach to set ins and outs on our targets, There's absolutely no need to see what happens the next day to that particular holding. We'd hit our target and we're out. The total return of this particular makeup or this basket of individual holdings during this time frame was 11.69% in that basically a little over 3-month period. Now, are there losses on here? Of course, we're not perfect. We don't make every decision right. But we set ourselves into the right targets to make sure that when we go back to that volatility in that chart, when the chart starts going the wrong way, instead of riding it out and riding it all the way down, we will cut our losses early and deploy that capital somewhere else. And we also do it with less capital at risk because remember, we're buying in quarter of positions. So all of this matters because this is a very active approach. This is what most people who love investing would die to be able to sit at their computer and do all day long. The reason it doesn't happen elsewhere is because it takes a lot of time. And our committee is built to be able to watch, monitor, and build our clients' accounts that way. So we're going to jump into liquidity diversification and then bring this thing to a close.
Thanks, Andrew. Again, it's all about intentionality here in whatever you're doing. And while none of us have got a crystal ball, if we can be intentional on the plan, surround ourselves with a team, usually we end up in a far better position. Now, we've all heard the phrase cash is king, right? Primarily going back to an earlier comment, a lot of that stems from when opportunity presents itself in the form of an investment, acquiring an asset, etc. It usually takes capital to do that. But one of the misnomers is that liquidity, meaning access to cash, equals cash. And that's simply not true. Right now, if I hold cash, I've got liquidity, but you can make an argument based on a variety of parameters that I'm actually losing money in that holding. Now, I'm not saying there's not cash, doesn't belong in part of a portfolio, pure cash, but it's certainly a short-term type of a need. Further, having your liquidity, having your capital be productive but easily accessible is what we strive to do to manage for many of our clients, depending on their situation. So much so that there's actually strategies to allow you to have access to that cash, but never disrupt the earnings of that cash, of that capital. It's arbitrage. As an example, if I needed $50,000 out of an account, let's just say to go and invest in maybe some real estate or to deploy out in some other opportunity, I could simply reach in, grab that $50,000, take it, sell the positions wherever it is, deploy it. Hopefully I've got a return over there. Great, I'm happy, right? But what if I could take that $50,000, move it over into this asset class, get the opportunity to return over here, but I never disrupted the growth. All the while, it still earned the same interest, dividends, earnings that it would have received had I left the money in there the entire time. That exists. We can actually help individuals grow 2 assets simultaneously in the right environment, thereby creating more wealth. This whole idea of concentration, and this really kind of goes back to the heart of diversification, right? I don't want to put all my eggs in one basket. I want to have a pie chart that has multiple different size asset classes. But if you take a step back, we've all got concentration in our lives. And something certainly that should be evaluated. If I'm a business owner, as I talked about previously, you've likely got most of your net worth or certainly assets associated with your net worth tied up in your business. If you're a real estate investor, like many that I know, love that asset class. Most of their net worth is tied up in real estate. If you are a high income earner, a lot of your net worth is tied up in employer compensation, right? 401ks, employer sponsored compensation, maybe profit sharing plans. I'll even take it a step further. Right now, there's a lot of investments in tech. We've got a lot of people in the tech industry. You can make an argument that if you're working in the tech industry and you've got a lot of investments in tech, you're overexposed to that sector. And so how do we begin to de-risk the concentration, still allow people to do what they want to do, invest in the way that they want to invest, but be more intentional on diversifying that particular risk? And at the end of the day, if we can create a foundation based on the various objectives, goals, and needs of individuals that has liquidity, access to cash, we've got non-correlated assets that are in there, predictable growth, we've probably insulated it from tax rate risk, which again is a huge, huge item of control. If we've got that built, we can then begin to layer on other types of investments. We can attack volatility like Andrew discussed. Take advantage of the chaos. Begin to be more intentional in the planning. Wrap all of those things up in the business and the tax and the estate. How do I want to transfer those assets to the next generation or to charitable endeavors that I'm interested in? If we can do all of those things, we believe that individuals truly have control over their wealth. As a result, we surround our clients with a team, or what we call a financial board of advisors. Why? Because candidly, not one advisor can be all things to all people. We've all got various specialties, areas of expertise, maybe just personalities, different outlooks. It makes sense to have individuals that can look at the holistic picture. And to further prove that point, most of you have probably got an insurance agent. Many of you probably have an investment advisor. And I would assume many of you have got a CPA and an attorney. When was the last time that they all sat in a room with you and talked about your situation holistically? Probably never. As a result, are there blind spots that are created? Are things coordinated correctly? You have to answer that question. We believe that an entire team needs to sit in there to truly put you in control. Now, Andrew and I don't know if the specific strategies, if the certain ideas that we've shared are right for you. What we absolutely know is that it's worth slowing down and thinking about what your current plan is doing. Should you adjust? Because usually that current plan was put in place with a different environment. Hopefully you've seen the environment has changed. As a result, should your plan change? So we absolutely know that these strategies, these approaches are worth learning more about, understanding, and overall exploring. Today's market's different. You need to adjust to current market cycles. And as a result, we believe our organization can put you far more ahead than where you might be currently. So with that, I want to thank you for your time.
Yeah,
Andrew, anything else that you'd like to say?
Appreciate you taking 45 minutes with us here today. Go through this. If you have found anything in here interesting, please reach out to the advisor that maybe sent this to you. Ask them to take a look at what it is that you're doing. Engage. They will bring in the right team members, as Craig mentioned, to look at your specific situation. And with all things, we've gone through a lot of examples today. We don't make the assumptions that we know your particular individual situation. We don't make the assumptions that everything that we are saying is right for you. But what we will do for you is we will customize our approach to give you back control and a plan built around your specific situation. If that's important to you, reach out, make an appointment with Prevail. Thanks for your time today, Craig. Thank you. Appreciate it. Have a good day.
Take care.